Various wings of the Indian government recently released a set of telling numbers on three of the nation's most crucial macroeconomic markers: inflation, industrial production, and trade. While all three numbers saw a dip, the implications of the drop are quite different for the different markers. Let's begin with the good news. India's retail inflation rate in April fell to an 18-month low on the back of a high base and easing price pressures across categories. Data released by the National Statistical Office or NSO on Friday showed that the CPI-based inflation stood at 4.7% in April, as against 5.7% the previous month. Due to moderation in the food, fuel, clothing and services prices, the headline inflation rate stayed within the Reserve Bank of India's upper tolerance limit for the second consecutive month in 2023. The RBI has an inflation target of 4% with a margin of 2 percentage points on either side. The Wholesale Price Index or WPI, which measures change in the overall price of goods before they are sold to people like us, also fell. But it went into the negative territory in the latest data. This is deflation. It fell to a near 3-year low of negative 0.92% in April. It is for the first time that WPI has slipped into negative territory in 33 months. The reason? A higher base effect and continuing contraction in prices of manufactured products. Data released by the Commerce and Industry Ministry on Monday showed prices for manufactured items contracted further, led by a decelerated price rise in items such as beverages, tobacco, apparel, leather, pharmaceuticals, and cement. Meanwhile, the growth in factory outputs measured by the Index of Industrial Production or IIP fell to 1.1% in March from 5.8% in February. This was largely due to a decline in output growth in manufacturing at 0.5% and a contraction in electricity output at negative 1.6%. Consumer goods, particularly durables, were amongst the worst performers in 2022-2023, though the output index of consumer durables was up just 0.5% in 2022 to 2023 compared to 3.2% in the previous year. It contracted almost 4% compared to the pre-COVID year of 2019-2020. This can be attributed to muted demand due to high inflation and loss of income during the COVID times. The recent deceleration in inflation may have a lag effect if the trend continues. However, the most troubling dip was visible in India's trade numbers. In April, exports fell to a 6-month low and imports did their worst in 20 months, both in value terms, as sluggish demand for Indian goods due to an economic downturn in key destinations and easing commodity prices weighed on India's trade basket. The data released by the Commerce Department showed outbound shipments from India witnessed a sharp 13% contraction at $35 billion during the first month of the fiscal year, while those inbound saw a sharper decline at 14% to $50 billion, leading to a 20-month low trade deficit at $15 billion. This is the third consecutive month of contraction in exports and the fourth for imports. Are we then witnessing the first shades of trouble in India's macroeconomic portrait?
Yes and no. Now, as far as the WPI is concerned, so it's a combination of a decline in the global commodity prices and the very high base effect that we had last year. Now, as far as the CPI is concerned, so the CPI has started to weaken, but if you look at it, not as fast as the WPI has gone down. So on the inflation numbers, nothing much to worry about. As far as IIP is concerned, IIP is very weak. It continues to be weak, which means that industrial recovery really hasn't started happening yet. This becomes more worrying when you look not just at the export numbers, you look at the export numbers and the import numbers, The export, of course, is a sign of global weakness. As far as imports are concerned, that's also showing weakness because there is a decline, absolute decline in the volume of imports as well. That's not good news.
And what could be the potential challenges and opportunities moving forward?
I don't think these are disturbing signs. I think the only problem area is exports. I think the opportunity still exists in promoting services exports. I think where the global capability centers, etc., are leading them. So we should focus on cashing on this opportunity in the near term. And second, I think the opportunity also comes from diversification of supply chains, some of which are moving towards India, not all of them. Now, the worrying part is the goods exports. The growth rotation away from US and Europe towards China doesn't help us. So I think the sectors which are labor intensive will require some support, I think, in this environment.
Experts therefore point out that the global environment is still fragile, but the interest rate hike cycle is also coming to an end in most parts of the world. So, inflation is likely to soften in the rest of the world too. But interest rates remain very high, and India should be wary of the spillover effects of risks that such high interest rates entail. They also believe that we must step up our domestic demand with a specific focus on incentivizing personal consumption.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.